Welcome to PyUncut, where we break down complex financial news into simple, clear, and actionable insights for everyone. Today, we are diving into an important update from one of Wall Street's biggest banks. Bank of America has just reset its outlook on Apple stock, and this move is getting a lot of attention across global markets. But what does this really mean for investors, and more importantly, what could happen next for Apple shares? Let's start by understanding the context. Apple is not just any company. It is one of the largest companies in the world, with a market capitalization that recently crossed $4 trillion. Its stock has been a favorite among investors for years because of its strong brand, loyal customer base, and consistent revenue generation. However, even giants like Apple are not immune to changing market conditions. Bank of America's latest reset of Apple's stock forecast reflects a mix of optimism and caution. On one hand, Apple continues to dominate in key areas like smartphones, services, and premium consumer electronics. On the other hand, there are emerging challenges that could influence how the stock performs in the near future. One of the biggest factors behind this reset is the evolving demand for iPhones. For years, the iPhone has been Apple's primary revenue driver, but global smartphone markets are maturing. In many developed countries, most consumers already own high-end devices, and upgrade cycles are becoming longer. This means fewer people are rushing to buy the latest model every year. Bank of America analysts are closely watching whether Apple can maintain strong iPhone sales in this slower growth environment. At the same time, Apple's services business is becoming increasingly important. This includes things like Apple Music, iCloud, App Store revenue, and subscription-based offerings. Services generate higher margins compared to hardware, which means they are very valuable for profitability. Bank of America believes that continued growth in services could support Apple's stock, even if hardware sales slow down. However, there are also regulatory pressures, especially in regions like Europe, where governments are pushing for more competition in app marketplaces. Another key factor is Apple's push into artificial intelligence. The tech world is currently going through a major AI transformation, led by companies like NVIDIA, Microsoft, and Google. Apple has been relatively quiet compared to its competitors, but it is now starting to integrate AI features into its ecosystem. Investors are asking a critical question. Can Apple turn AI into a meaningful revenue driver, or will it lag behind competitors? Bank of America's revised outlook reflects some uncertainty here. Let's also talk about valuation. Apple's stock is trading at a price-to-earnings ratio of around 34. This is relatively high compared to historical averages. A high valuation means investors are already expecting strong future growth. If Apple fails to meet those expectations, the stock could face downward pressure. This is one of the reasons why analysts are becoming more cautious. They are not saying Apple is a bad company. Instead, they are questioning whether the current stock price fully reflects the risks ahead. Now let's zoom out and look at the broader market environment. Interest rates remain a critical factor. When interest rates are high, investors tend to shift money away from growth stocks like Apple and into safer assets like bonds. This can put pressure on tech stocks overall. Bank of America's outlook takes this macroeconomic factor into account, suggesting that Apple's performance is not just about the company itself, but also about global financial conditions. There is also the issue of supply chains and geopolitics. Apple relies heavily on manufacturing in countries like China. Any disruption in trade relations or production capacity can impact Apple's ability to deliver products on time. In recent years, Apple has been trying to diversify its supply chain by expanding production in countries like India and Vietnam. While this is a positive long-term move, it also comes with short-term challenges and costs. So what exactly could happen to Apple shares next? According to Bank of America's reset, there are a few possible scenarios. In the bullish scenario, Apple successfully drives growth through services, AI integration, and new product categories. This could lead to steady revenue growth and support higher stock prices. In this case, Apple could continue to be a strong performer in the tech sector. In the neutral scenario, Apple maintains stable revenue but struggles to find new growth drivers. iPhone sales remain steady but do not grow significantly. and services growth slows down slightly. In this situation, the stock could move sideways, delivering moderate returns but not outperforming the broader market. In the bearish scenario, multiple challenges hit at the same time. Slowing iPhone demand, regulatory pressures, weaker global economy, and high valuation could combine to push the stock lower. This is not the base case, but it is a risk that investors need to consider. For beginners, the key takeaway is this: stock prices are not just about how good a company is. They are about expectations. Apple is still a very strong company, but its stock price already reflects a lot of optimism. When expectations are high, even small disappointments can lead to sharp price movements. Now let's talk about what investors should watch going forward. First, keep an eye on Apple's earnings reports. Pay attention to iPhone sales numbers and services revenue growth. These are the core drivers of the business. Second, watch for announcements related to AI. Any major innovation or product launch in this area could change the narrative around Apple's growth potential. Third, monitor macroeconomic trends like interest rates and global demand. These factors influence the entire tech sector. Another important point is diversification. Even if you believe in Apple's long-term potential, it is always wise to diversify your investments. Relying too heavily on a single stock, no matter how strong it is, can increase risk. Historically, Apple has gone through multiple phases of doubt and reinvention. From the iPod era to the iPhone revolution, and now into services and potentially AI, the company has consistently adapted to changing market conditions. This track record is one of the reasons why many long-term investors remain confident in Apple's future. However, the market environment today is very different from a decade ago. Competition is more intense. Innovation cycles are faster, and global economic conditions are more uncertain. This means Apple needs to execute perfectly to justify its current valuation. In conclusion, Bank of America's reset of Apple's stock forecast is not a warning sign of collapse. Instead, it is a reminder that even the strongest companies face challenges. The future of Apple shares will depend on how well the company navigates slowing hardware growth, expands its services business, and positions itself in the AI-driven future. For investors, this is a moment to stay informed, stay balanced, and avoid making decisions based purely on hype or fear. Apple remains a key player in the global tech landscape, but the path forward may not be as smooth as it once was. That's all for today on PyUncut. If you found this breakdown helpful, stay tuned for more deep dives into the world of technology, finance, and investing.